In case you missed it, a leading recession indicator just started flashing a warning light. This indicator is so accurate it's been right 100% of the time in the last 70 years. I'm talking about US bond yields, and if you don't understand how they work, don't worry, because I'm going to explain why they have people so spooked, what history tells us about what might happen, and when a recession could hit. Plus, I'm going to look at some of the tough conditions we're seeing right now in the economy, as well as the Russia-Ukraine crisis, and how these things are leading towards our second recession in less than 24 months. Check out this chart. This graph shows the difference or spread between the 10 and 2-year US Treasury bond yields. When the line dips below the horizontal axis, it means yields have inverted. This is known as the inverted yield curve. And then you'll notice the shaded bits here, that indicates a recession. I think to understand why they're linked, I'll need to do a quick explainer of bond yields. You can think of them in kind of the same way as term deposits at the bank, where you're offered an interest rate to lock your money away for a set period of time. The longer the term period, the higher the rate you're normally offered. And that's because locking your money away for a longer period of time is riskier. Interest rates could rise, meaning you're in an underperforming product, and it's hard to predict where the economy will be. But when short-term bond yields are just as high or higher as long-term bond yields, investors are predicting the immediate future is even more of a risk. At no time in the past has this indicator been wrong. The thing is, we've only just come out of a recession in 2020, and we've barely recovered. So it begs the question, what might this next recession look like? Okay, before I get into answering that, if you're enjoying this video, please give it a like so it can be seen by more people, and subscribe to the channel if you're interested in seeing more content like this. Okay, so what's going on that has investors so spooked? So this almost seems like a redundant question because, as you know, there's a lot going on right now. First, inflation levels around the world are sitting at 40-year highs and continuing to get worse. That means everyday prices for things like petrol, food, and your morning coffee is getting more expensive. This was triggered thanks to COVID-19, which resulted in business layoffs and supply chains, in other words, the product getting from A to B breaking down. The pandemic is also continuing to take its toll on economies. Many countries still remain closed off from each other, and many businesses that rely on people leaving their homes, they've still not recovered, and many never will. Interest rates are at record low levels, and central banks say they plan to raise them in 2022, and they need to do this in order to combat rising inflation. But that can also trigger a recession. In fact, a rising rate environment has triggered a recession 60% of the time in the past. Not a lot of us would know this because we've only seen interest rates go down really for the last few decades. Government, public, and corporate debt levels in the US and around the world are at record high levels. So while the Fed needs to raise interest rates, it also knows doing so will cost the economy a lot. Some households and businesses will probably go into default when this happens. And now we have the conflict in Ukraine, which many now consider to be a full-blown war. All of the other issues had been there for a while now, but the Russia-Ukraine crisis, apart from being a serious humanitarian crisis, unfortunately just magnifies those pre-existing problems. So let's start there. What economic impact can we expect from the war between Russia and Ukraine? In a recent interview with the BBC, the president of the World Bank called the war in Ukraine a catastrophe for the whole world that will hit economic growth. The main reason economically is that it will cause already high inflation to reach even higher levels. And there are two big reasons for this. First, inflation is often caused by rising energy costs. Energy being electricity, oil, and gas, basically the ingredients that are needed to produce food and other goods. When energy becomes expensive to produce, everything else becomes expensive. Almost 40% of Europe's electricity comes from oil and gas, and Russia is the biggest producer of this. In fact, Russia is one of the top 3 biggest producers of crude oil in the world, next to Saudi Arabia and the US. If the conflict impacts Russia's oil output, either due to sanctions that are placed on Russia or simply because the conflict physically interrupts oil production, we can expect oil prices, and so all energy prices, to jump. In fact, very soon after news emerged that Russia had invaded Ukraine, oil prices jumped to over $100 a barrel for the first time in almost a decade. Today they're more like $130 a barrel and going up fast. That price impact will trickle all the way down to the cost of the petrol you put in your car to your Sunday brunch. And the food on your plate isn't just going up because electricity and oil prices are going up. Russia and Ukraine are also major food producers. Russia and Ukraine produce 60% of the world's sunflower oil and almost 30% of global wheat exports. The US and NATO allies have placed sanctions on Russian goods, meaning they either entirely block or limit what Russia is able to sell overseas. Unfortunately, those sanctions also have a spillover effect onto the rest of the world, increasing prices of those goods everywhere. In a recent note from the IMF, it said the global impact from the war would be severe. It said price shocks will have an impact worldwide, especially on poor households, for whom food and fuel are a higher portion of expenses. Russia has also been cut off from financial markets. Or rather, it has been cut off from using SWIFT, which is a financial messaging system that essentially allows global banks to transact with each other, the most popular one in the world. If you're not on SWIFT, it will essentially slow operations down, which is bad news for Russia's economy. But once again, it's also bad news for other economies, such as the EU, which is continuing to rely on oil and gas purchases from Russia. Those banking transactions on both sides will be a lot slower, at least until a good alternative is implemented. This is a supply chain blocker, another factor pushing up prices and inflation. And then of course there's the economic toll of over 1 million refugees seeking shelter. The cost of rebuilding Ukraine's infrastructure and the billions in funds coming from ally countries to support Ukraine's government and its troops. And these costs will only go up the longer the war continues. Okay, next up we're going to talk about a key part of this puzzle, interest rates. I look into what history can tell us about our current situation, when economies and banks think the recession is coming, and what I'm going to be doing with my money. So one of the main ways central banks can attempt to cool rising prices is to raise interest rates. The US Federal Reserve has already indicated that it will increase the official cash rate sometime in 2022. Like I said before, this is unfortunately another main trigger for a recession. A quick explainer of how that works in case you're lost. The official cash rate is the rate that banks use to borrow money from each other, primarily the central bank. So the rates they offer customers like you or I is always dictated by that cash rate. If the official cash rate goes up, you can expect the interest charged on your mortgage or other types of loans will also go up. When it costs more to borrow money, people tend to stop borrowing as much. When people stop buying stuff, demand drops and prices should also drop. This is why central banks drop interest rates when they want to encourage more spending, hopefully resulting in economic growth. But when that starts to get out of hand and inflation gets too high, they will increase interest rates. So a rising cash rate environment typically triggers an economic slowdown, which is okay so long as the economy is relatively healthy. But we've just exited a pandemic, and there is now an ongoing war in Europe, which will continue to push prices up. If rising inflation rates don't manage to curb inflation, we could have a serious recessionary environment similar to what we saw in the 1970s, where inflation was rising, interest rates were rising, and so was unemployment. All the while, economic growth was going in the opposite direction. This is called stagflation, and if we do enter a recession, which is looking quite likely, it's a particularly nasty kind. And for the everyday household, it means people are earning less money even as prices are increasing. So 50 years ago, central banks faced a similar situation. As a result of stimulus offered by the Federal Reserve to deal with 2 recessions in the 1970s, the US economy was running hot, and inflation was running into the double digits, made all the worse by an oil embargo. After the Fed raised interest rates, the inflation rate eventually dropped, but so did the economy as recession set in. It's a hard balance. In the best case scenario, today's Fed will be able to slow down the economy enough to reduce the inflation rate without unemployment rates increasing and a recession occurring. That's what we can hope for, but we don't know until it occurs. Not even the Fed can predict exactly what impact its policies will have on the global economy. The inverted yield curve is essentially a predictor that interest rates will rise, and a rising rate environment is a pretty good predictor of a recession. In fact, recessions have occurred about 60% of the time during rising interest rate environments, as Goldman Sachs tweeted somewhat optimistically. Of these instances, a recession typically hits around 37 to 42 months after the first rate hike, but they have also appeared in less than a year, which would mean we could comfortably predict a recession will hit the US and likely the rest of the world too, sometime in 2023 at the earliest, but more likely in 2024. Economist Bill Connolly penned this note in a recent article: "A recession will come to the United States economy, but not in 2022. Federal Reserve policy will lead to more business cycles, which many businesses are not well prepared for. He said the downturn won't come in 2022, but it could arrive as early as 2023. And if the Fed avoids recession in 2023, then look for a more severe slump in 2024 or 2025. Cathie Woods also penned in January, during the next 3 to 6 months, the market is likely to focus more on the risk of recession in the US, as well as the serious slowdown in the Chinese and emerging market economies. The good news is that in many ways, we've been here before. There are some complications, including that we're facing record levels of debt and we're still recovering from the pandemic, but for the most part, we've handled similar scenarios and we've come out the other side. We're not there yet, but the next 12 months are expected to see a significant slowdown from the previous 12 months. The World Bank said it expects emerging and developing economies growth to drop from 6.3% on average in 2021 to 4.6% in 2022 and 4.4% in 2023. But of course, this all before the Russia-Ukraine crisis. And on the plus side, the US economy is sitting on healthy levels of employment. The February jobs report showed unemployment had fallen to 3.8%, which means there's still a lot of leeway before anything gets serious. So what am I doing to prepare? Well, I'm continuing to invest for the long term by dollar cost averaging into ETFs. And I have my emergency cash fund earning as much interest as I can get to keep it above inflation. I'm not making any big stock purchases, but I am starting to put together a new shopping list of stocks to buy ahead of a recession. Let me know in the comments, when do you think the recession is coming, and are you doing anything to prepare for it?